Now you know the 3 building blocks, but there's one question that can completely change the results of your portfolio. How much should you put into each one? Because owning the right investments isn't enough. You also need the right allocation for you. And here's where a lot of investors make a mistake. They search for one perfect portfolio percentage. But there is no single allocation that's perfect for everyone. Your ideal mix depends on 3 major things: your time horizon, your risk tolerance, and your financial goals. Vanguard makes the same point in its asset allocation guidance. The appropriate mix depends on factors including goals, time horizon, risk tolerance, and financial circumstances. So instead of giving you one magic number, let's look at 3 different approaches. First, the aggressive investor. Imagine you're relatively young, you have decades before retirement, and you can handle seeing your portfolio fall significantly during a market crash without panic selling. An example would be 80% stocks and 20% bonds. You could divide the stock portion between US and international markets. For example, 60% US stocks, 20% international stocks, 20% bonds. The exact percentages aren't a recommendation for everyone. They're simply an example of how a more aggressive 3-fund portfolio could be structured. And here's the important part. An aggressive portfolio isn't automatically better. It simply takes more risk in exchange for potentially higher long-term growth. Vanguard similarly uses an 80% stock, 20% bond allocation as an example of an aggressive strategy. Next, the moderate investor. This investor still wants growth, but doesn't want their entire portfolio depending on stocks. One commonly used example is 60% stocks and 40% bonds. For a 3-fund structure, you could divide the stock allocation between US and international stocks. For example, 40% US stocks, 20% international stocks. Again, this is an educational example, not a universal prescription. The important concept is balance. You give up some potential growth in exchange for potentially reducing portfolio volatility. And this classic stock and bond approach remains relevant. Recent market analysis has noted that the traditional 60-40 portfolio continues to be widely used as a balanced framework. The conservative investor. This could be someone approaching retirement or someone who simply doesn't feel comfortable with large market swings. Consider a portfolio with 40% stocks and 60% bonds. The potential growth is lower than an aggressive portfolio, but the goal is to create a portfolio that's easier to live with during market turbulence. Because here's a lesson many investors learn too late. The best portfolio isn't necessarily the one with the highest theoretical return, it's the one you can actually stick with. If your portfolio drops dramatically and you panic and sell, your carefully designed investment strategy doesn't matter anymore. Now let's talk about one of the most important concepts in this entire strategy: rebalancing. Imagine you start with 60% US stocks, 20% international stocks, 20% bonds. Then the stock market has a fantastic year. Your stock allocation grows. Suddenly, your portfolio might look more like 70% stocks, 15% international, 15% bonds. You didn't intentionally choose that new allocation, the market chose it for you. That's where rebalancing comes in. The idea is simple. You periodically bring your portfolio allocation back toward your chosen target allocation. You don't need to obsess over it every week. In fact, that's the opposite of the lazy investor philosophy. The goal is to establish a plan, then maintain it with as little unnecessary activity as possible. Here's one of the biggest traps investors fall into. They see something going up, and they buy it. Then they see something else going up, and they buy that too. Eventually, their portfolio becomes a collection of whatever was popular over the last 12 months. That's not a strategy. That's performance chasing. A lazy portfolio takes the opposite approach. Instead of asking, what's going up right now? What allocation did decide to maintain for the next several decades? That's a completely different mindset. And here's another mistake, thinking that more ETFs automatically means more diversification. It doesn't. You could own 30 ETFs and still have enormous overlap. For example, you might own an S&P 500 ETF, a technology ETF, a growth ETF, a NASDAQ ETF, and several other funds, only to discover that many of them own the same giant companies. More funds can create the illusion of diversification without actually providing much additional diversity. The three-fund philosophy is different. Each fund has a clearly defined job: US stocks, international stocks, bonds. Simple. There's another important decision. How much of your portfolio should be international? There's no universal answer. Diversification outside the US can reduce dependence on a single country's economy and market. Vanguard's research says the biggest reduction in volatility from adding international equities historically came. Investors moved from 0 to about 20% international exposure, with additional diversification benefits extending at higher allocations. The key takeaway? You don't have to predict which country will outperform. You can simply own both. That's one of the most powerful ideas behind diversification. But here's where the lazy investor portfolio becomes truly powerful. It's not the 3 ETFs themselves, it's the behavior behind them. Imagine you automate your investments every month. The market rises, you keep investing. The market falls, you keep investing. The news says recession, you keep investing. The headlines say stocks are going to explode. You keep investing. You don't need to predict the future. You simply continue following the plan. That's the real advantage. Consistency beats excitement. If you want to follow this philosophy, remember these 5 rules. Rule number 1, keep your portfolio diversified. Rule number 2, keep investment costs low. Lower costs leave more of your potential return invested over time. Vanguard specifically emphasizes cost-conscious investing as an important part of long-term investing. Rule number 3, invest consistently. Don't wait for the perfect moment. Rule number 4, rebalance instead of chasing performance. Rule number 5, give your portfolio time. Because the biggest advantage you have as a long-term investor isn't predicting tomorrow, it's having decades for compounding to work. So now we have the portfolio. We understand the 3 ETFs, we know how allocation works, and we know why simplicity matters. But there's one final question. Can a simple 3 ETF portfolio actually build serious wealth? What happens if you invest just $100 a month? What if you invest $500? What if you invest $1,000 every month for decades? In part 3, we're going to run through the numbers, see how compound growth can transform relatively small monthly contributions, and reveal the most important lesson of the entire strategy. Because the goal isn't to find the perfect investment, it's to build a system and actually stick with it.